Ladies and gentlemen, good morning, and welcome to the Q3 and 9-month FY26 earnings conference call for Gokaldas Exports Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Kasturi Sharma from EY's Investor Relations team. Thank you, and over to you, Ms. Kasturi.
Thank you, Swapnali. Good morning to all the participants on the call. Before we proceed, let me remind you that the discussion may contain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our business risks that could cause future results, performance, or achievement to differ significantly from what is expressed or implied by such forward-looking statements. Please note that the results and presentation have been shared on email, and the same are also available on the company's website. In case you haven't received the same, you can write to us and we'll be happy to send them over to you. To take us through the results and answer your questions today, we have the top management of Gokaldas Exports Limited, represented by Mr. Sivaramakrishnan Ganapathy, Vice Chairman and Managing Director, and Mr. Satyamurthy, the Chief Financial Officer. We'll start the call with a brief overview of the quarter gone past, followed by the Q&A session. With that, I'll now hand over the call to Shiva sir. Over to you, sir.
Thank you so much. Good morning, everyone. Happy to have you at our earnings call for the third quarter of FY26. This was the first full quarter impacted by the steep 50% US tariff on India and the expiry of AGOA, which provided duty-free access from Africa to the US. The UK FTA signed in July 2025 has still not taken effect. In the meanwhile, many competing countries in Asia had a relatively advantageous 20% reciprocal tariff to the US and duty-free access to EU and UK. To combat this, we initiated several measures like securing our US business by strengthening our relationship with customers and offering discounts on US shipments from India to part offset the steep tariff. Secondly, streamlining operations across India and Africa to extract further efficiencies to reduce unit cost of operations. And thirdly, striving to increase business from Europe by increasing volumes with existing customers. We've also initiated the onboarding of a new customer from EU. The expiry of AGOA impacted the order book for Africa in Q3, resulting in a dip in revenue from the region. Further, there were some supply chain disruptions in Africa which impacted the business in the region. Imposition of incremental reciprocal tariff on Asian countries from August 25 resulted in Africa regaining its tariff advantage. There is a reasonable possibility of AGOA getting extended soon. This has allowed us to rebuild the Africa order book for future periods. During the previous call, I had talked about a transformation from seeing tariff as an enemy out to defeat us to recognizing it as a source of power and knowledge that would make us formidable. We continue to seek ways to invent ourselves and leverage our strengths to deal with demanding externalities. In the quarter, we reported a total income of 998 crores, a flat year-on-year performance. Our India operations continue to maintain its growth momentum, registering a growth of 8% YOY, despite being impacted by the steep US tariff for the entire quarter. We reported an EBITDA of 96 crores, a decline of 18% year-on-year. This was primarily due to sharing a considerable portion of the US tariff burden with our key customers. Adjusting for the burden share, our EBITDA should have grown by 17%. On the demand front, apparel exports into the US witnessed a continuous decline since July 2025, despite retail sales posting a stronger growth during that period. Most US retailers have so far not increased the prices for their customers. This is likely to change in 2026 as retailers are seeking to pass on some of the cost increases to their customers. Clearly, brands in the US are hesitating to build inventory at higher tariffs and/or may be anticipating flagging sales in 26. Imports from EU and UK showed a higher growth in the period January to November 2025 over the same period previous year. For the quarters ahead, The company has the visibility of a good order book for both India and Africa business. On the margin front, we anticipate U.S. reciprocal tariff on India to continue to impact the next quarter. Any positive outcome on U.S.-India trade deal would, of course, offset this impact. Africa business is seeing some tailwind. Our strategic investments in BTPL, which is a fabric processing unit, strengthens vertical integration, enabling better customer service, faster delivery, and creates an opportunity to improve margins. Our fabric investments and diversification into Africa will support our ability to somewhat deal with the steep U.S. tariff burden. Significant progress is being made in these areas. We are also directing capital expenditure into areas that will support our future growth. In the long term, the recently announced India-EU FTA will open access to a significant market, placing Indian exporters at par with key competing countries like Bangladesh, Vietnam, and a 12% duty advantage with China. This, along with India-UK FTA, would accelerate sourcing from India. High U.S. tariff continues to remain a source of concern. Thank you for listening. I would be happy to address any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Before we take the first question, ladies and gentlemen, you are requested to limit your questions to two per participant. If you have a follow-up question, please rejoin the queue again. We will wait for a moment while the question queue assembles. We have the first question from the line of Rehan Syed from Trinetra Asset Managers. Please go ahead.
Good morning to the team and thank you for giving me the opportunity. So, sir, my first question is around the margin structure as I want to understand. So, while your investor presentation explains the immediate cost pressure, so if you strip out explicitly disclosed one-offs, so do you believe the current gross margin profile reflects a new base, or is there any embedded operating leverage that is not visible at current utilization level?
There is some sort of an echo. I'm sorry, I couldn't hear you properly. Would you be able to repeat your question probably and more slowly?
Yeah, sure. Yeah. So, while your investor presentation explains that immediate cost pressures, so if we strip out explicitly disclosed one-off, so do you believe the current gross margin profile reflects a new base? So, or is there any embedded operating leverage that is not visible at current utilization level?
What was the question?
If there is any one.
I couldn't understand.
If your question is there any one-off expenses impacting this quarter?
Yeah. That is not visible to us.
Apart from the tariff effect, whatever we have disclosed, we have also taken a hit of 3.4 crores on account of our gratuity restatement because of the new labor wage code. So, other than that, is all regular, whatever has been reflected.
Was that the question? I'm sorry, really, I couldn't really understand your question on account of...
So my question is basically that the one-off that you have disclosed, apart from any other disclosed activities, we have to consider...
Sorry to interrupt in between, Rehan. I would request you to kindly use the handset mode to ask a question.
Okay. Am I clear now?
Yeah, you're better.
Yeah. So that's what my question that I'm asking that apart from the disclosed one-offs, is there any other one-off that we have to consider in the current margin level?
No, as Satya said, barring that labor code related gratuity provision, which was mandated by the new labor code, that was a one-time to an extent of 3.5 crores. There is no other one-time. The whole U.S. tariff burden is the burden that is the impact that we've had during this quarter, and that amounts to about 40 crores, 40.2 crores. That's the net cost of tariff burden that we shared with our customers.
Okay. Okay. And my second and last question is around just wanted to understand regarding the product mix as a margin lever. So what proportion of current revenue comes from program-based or repeat orders versus seasonal or fashion-led orders? And how does this mix impact margin stability across cycles?
So almost all our business comes from fashion orders. We don't do large program-based orders as yet. In the future, we may be doing it, but most of the orders are sought and won every on a seasonal basis. We do get usually a year-round visibility from our customers at a macro level, and then specific style-wise orders come at the beginning of each of the fashion season, primarily to allow us to buy the fabric and convert them. The reason why we focus on such programs are that they are better margins as opposed to year-round programs where we end up competing with Bangladesh or other low-cost regions who may also play the tariff game.
Okay. Okay. Yeah, that's from my side. I'll join back in the queue.
Thank you.
Thank you. We have the next question from the line of Kaustubh Pawaskar from ICICI Securities. Please go ahead.
Yeah. Good morning, sir. Thanks for giving me the opportunity. So my question is again on the margins. I just want to understand that this quarter we have seen full impact of US tariffs, and despite that, on sequential basis, if you see, excluding the other income, you manage margins. You were able to maintain the margins at around 8%, or if you exclude the other income on consolidated basis. And again, in this quarter, we have seen the Africa utilizations were quite lower, considering the AGOA effect, and there was some supply disruption. So I believe that the Atraco margins would also be at the lower end. So considering that, in quarter 3, should we expect the margins to remain at this level or better off, considering the fact that we might see some utilization level improving in Africa? India is doing reasonably well despite the fact that the US tariff continues to hit the margins. We have done well. So just an understanding from your end.
Sure. So AGOA impact, while AGOA's full brunt was faced in Q3, we also had some issues in Q2 because AGOA expired on 30th September 2025, and that is for shipments landing in the US on or before 30th September. So even second quarter was impacted. In fact, we did have an improvement in EBITDA margin in Q3 in Africa thanks to a lot of operational initiatives we took, and that will continue to sustain in the quarters ahead. In Africa, we would see a margin improvement, a good margin improvement, primarily because from Q4 we have built a solid order book, primarily because in the month of August we saw Asian countries see their reciprocal tariffs go up to 20%, while Africa remained at 10%. So we do have, even without AGOA, Africa enjoying a superior tariff regime as far as US is concerned. So that has also helped us to build the business in Africa. There is a likelihood of AGOA getting restored, likely with retrospective effect. That's work in progress, and we will have to wait and watch when that happens. But if that happens, then there will be further business fill-up to Africa. So with that in mind, we are strengthening the business prospects in Africa. In fact, operations are more or less well set. We will see some good EBITDA contribution going forward. So in some ways, you could say that region has bottomed out, and performance will improve from Q4 onwards. India, our performance will really depend on when the US reciprocal tariff gets corrected. Until then, we will continue to seek operational improvements to offset the steep reciprocal tariff that we are facing. any ways to reduce costs, take out efficiencies, etc., is on the cards, and we are working on it. That partially explains why this Q3 we were able to pull some good performance out of India, and we will continue to seek that going forward. So I would think that Africa will see business prospects improving because of macroeconomic improvements. India, until the U.S. tariff corrects, the macroeconomics will remain what they are. In the longer run, EU FTA will kick in, and so will UK FTA. But until that happens, we may see some degree of status quo with improvements only coming in from internal improvements that we will usher in.
Right. So my second question is understanding on the India business. So this quarter we have seen 6% growth, and you, in your initial comment, you mentioned that you are seeing a uptick in volumes from EU and UK, where you are trying to increase the orders for your existing client, and you are trying for the new customers. So is that helping us to achieve this growth? Because US, I believe there might be some decline in sales for this quarter, considering the overall decline in alcohol, whether you were able to maintain whatever sales or the order was on the year-on-year basis.
So we have managed to protect ourselves, from an order perspective, protect our business from US tariffs. We have maintained our business volumes. If you look at our revenues for Q3, which is more or less flat with Q3 of last year, this is after accounting for discounts for US customers. So in some ways, we have actually grown the business YOY. And that is because, we continue to serve our customers well. We continue to keep the business within our, business fold and ensure that we deliver well. So U.S. consumers are continuing to repose faith in Gokaldas in India. In fact, adjusting for discounts, in fact, there has been a minor growth. And I look at our order book for Q4 and Q1 of next financial year. We have a decent, robust order book for both the quarters. So we are holding on to the business. The concern remains that if the U.S. reciprocal tariff remains for the incremental penal tariff remains for a long term, then what happens? We will have to wait and watch how that unfolds. But for now, we are holding on to business. We have, in fact, minorly increased our business with U.S. customers. With European customers, we are growing very fast. We continue to do that. We have also, as I said in my opening remarks, we've added one more customer whom we will onboard in the next 1 or 2 months. So that will also give a further incremental growth from European business side. So we are seeking ways to de-risk ourselves. This is a journey that we will go through in the next several quarters, where we will rebalance, at least out of India, the business between US and Europe. European customers generally are smaller in size compared to US customers. So it takes a bit more time, but we are working aggressively on that strategy to balance our revenue between these two regions going forward. Hope that clarifies.
Right. Yes, sir. So last one, in earlier call, you mentioned that diversification is one of the strategies we're looking in terms of the production base. So you were looking at Bangladesh as one of the options if this tariff issue continues for another quarter or so. So any comment on that front, whether you are looking to shift some of the base or production base to Bangladesh from where the tariff rate is around 20% and you can benefit from there?
Sure. So we do have some subcontract relationships in Bangladesh, and we exercise that option all the time. And even now, we do use those capacities for our benefit. Any investment in Bangladesh would be considered only after some clarity on the macroeconomic situation in Bangladesh. There is an election supposed to happen sometime in February, and we will take a call post that, looking at how Bangladesh shapes up. In the meanwhile, we are also open to looking at other geographies. So all those are work in progress. It may take time. It all depends on what our final conclusion is on relative attractiveness of those regions, as well as how the tariff situation plays out in India. So we're working on it. Bangladesh at the moment is only a subcon kind of arrangement. Making investments in Bangladesh, we will wait and watch till there is more clarity on geopolitics in that region.
Okay, sir. Thank you. And all the best for the quarter.
Thank you.
Thank you. A reminder to all the participants, kindly limit your questions to 2 per participant. If you have a follow-up question, please rejoin the queue again. We have the next question from the line of Vishal Mehta from IIFL Capital. Please go ahead.
Yeah. Hi, and thanks for taking my question, and I would say a resilient performance in the tough times. Just to start with a clarification, these tariffs also have bearing on your revenues, right? So adjusted for these, your revenues also would have been up 40 crores?
Yes.
Okay. Wanted to understand on AGOA and Africa operations. Apart from AGOA, you called out there were some supply chain challenges there. So what are these, and is the AGOA disturbance now behind us in Africa? Would it be safe to say that?
Sure. So the AGOA, the supply chain challenges were actually there was some port congestion in Mombasa port. And that meant that, a lot of fabric which we were importing from China, etc., got held up for over 25 days, sometimes even 30 days, which resulted in operations getting impacted there. All that is behind us. There was also, this AGOA impact. And AGOA impact was primarily because in the early phase of AGOA, when it got when the US let it expire in September 2025, we had only 10% tariff in rest of Asia. But since then, US has now imposed 20% tariff on rest of Asia, while Africa continues to have a 10% reciprocal tariff, bestowing Africa a 10% advantage vis-a-vis rest of Asia and a 40% advantage vis-a-vis India. Now, there is a talk of AGOA being reinstated. Now, we will wait and watch as to when it happens. It's going through the U.S. Congress. House of Representatives have already passed the bill, but it has to go through Senate and the President. So let's wait until that happens. But if AGOA is restored, then, we will see a massive tailwind for Africa, primarily because the duty delta between Africa and rest of Asia will widen even more. It will widen by another 20-odd%. So we'll wait for that. In the meanwhile, even without AGOA, we are seeing a fairly good traction build up for that region.
Okay. No, so just a follow-up here, because last quarter probably we were expecting that there was a sudden disturbance in Africa order execution, and we faced challenges there, and then we were expecting it to pick up this quarter, but still we continue to see challenges. So now for the upcoming quarter, do you see order book all healthy, and we should probably see better growth, better margins there?
Yeah. So when I say last quarter there was a problem, I had said that last quarter, and that will spill over to this quarter as well. So this was expected that
Okay.
Even this quarter will get impacted, because bulk of the impact started from October. So this quarter did get impacted. The subsequent 20% tariff for rest of Asia obviously helps Africa. Do I see improvement going forward? Absolutely, yes.
Okay. Thanks. I'll join back in the queue.
Thank you. We have the next question from the line of Ronak Shah from Equirus Securities Private Limited. Please go ahead. Ronak, please proceed with your question.
Yeah. Thanks for the opportunity, sir. Am I audible?
Yes, you are, Ronak.
Yeah. So, sir, larger part of the margin benefit is coming from the gross margin expansion. So despite we have passed on certain discounts to the end consumers, so can you make us understand what has led to this? Is it because of the realization mix related gains, or is there something different in between?
The gross margin improvement happened because of more productivity gains and also product mix changes. So we had usually in spring summer we do have a lot of India-based fabric that we use, and we also did a strong negotiation with fabric suppliers given the tariff related challenges that we had. So all of that also helped us.
And sir, from the tariff perspective, as per our earlier understanding that the penal part is largely getting absorbed by the manufacturer, is there any change in that part, or is it still continued?
Can you say the question again?
Yes, sir. So as per our earlier understanding, within the tariff part, larger part of the penal portion, which is 25% is absorbed by the manufacturers. So is there any change in that part, or is it still continued?
It is still continuing. So penal tariff, large portion we are absorbing. We are trying our best to pass on some of the cost increases to our suppliers as well. So we do that too. Trying to recover some of those additional burdens from our supply chain.
Got it. And sir, lastly, from the volumes front, can you call out separately what is the Indian business and African business volumes in the third quarter as well as 9 months?
Okay. I'll give the total volume is 15.53 million. 572 rupees is the realization. And for standalone, for India, I have separately for Africa. Africa is 3682, 3.68 million. 400 rupees. 402 rupees is the realization. The differential is Indian operation.
Okay, got it. For 9
months, Africa volume is 10.65 at 428 rupees.
Okay.
And the total volume is 41.13 million, 650 rupees. 649.
Okay, got it. Thanks. That's it from my side. Thank you.
Thank you. We have the next question from the line of Rohit Maheshwari from Tata AIG. Please go ahead.
Good afternoon, sir, and congratulations for good set of numbers in these difficult times. So my first question is, out of the 40 crores which you have taken, what was the total impact of the penal tariff?
I think the total impact of the penal tariff was closer to 60 crores, and we set off about 20 crores of it from our supply chain.
Okay. And do you, if this penal tariff does not go for next 2 or 3 quarters, do you think this 40 crores will be there till the time this penal tariff do not get solved?
Of course, yes.
Okay. And because now it has been more than like 5.5 months we have been talking about, are you finding any different attitude of US buyer towards now negotiating new deals with them, or do you, because you don't want to lose a customer, you have been negotiating the way to just customer stays with you?
No, so we've been negotiating with the customers so that we can ensure and assure the customers to stay with us. So that's going on. We are hoping that there should be some resolution to the US tariff sometime in the near future. We're waiting for it so that the playing field gets leveled up between India and rest of Asia. Until then, these discounts are the panacea for the situation that we have, and that's the best we could do. I think in the longer run, we need to see a more, equalized tariff between ourselves and the rest of Asia. So the other option for us is actually to increase our business from Africa as well as increase European business in India, both of which we are doing to combat this.
Okay. The last question is, do you, it's an interrelated. One is, can you call quarter three as a bottom out for Gokaldas in terms of margin, in terms of growth? And second is, when you're looking for European business, because the order quantities are small, the margin profile will be better than the US customer, correct?
So to answer your first question, is this a bottom-out performance? From an India perspective, while it is a bottomed-out performance, we will see that, Q4 also somewhat similar because, the tariff regime is not changing. So, any improvement will only come through operational improvements from an India business standpoint. So yes, we have bottomed out, and hopefully we should, once the tariff situation changes or improves, we'll see improvements. But as far as Africa is concerned, we have bottomed out, and we should start seeing improvements going forward. So on a Concall basis, I think we can say it firmly that this is a bottomed out performance, and going forward, things should better from here on. Primarily led by international operations. What was the next question?
Second question is, when you are getting additional business from the European customers, so the margin profile will be better than the US customer.
Margin profile is better than US now because we are in that regime of penal tariff, and we are offering some discounts to US customers. The European customer margin in these circumstances are better. But if you look at it from a pre-US penal tariff standpoint, US businesses are much better than Europe simply because of the size of the relationship, the scale of operations, etc., that we get from US customers. So European businesses, given that the retailers are a bit smaller, we tend to have a little sharper margins. Also, Europe gets duty-free access from Bangladesh, Pakistan, Sri Lanka, Vietnam, so many places. So they tend to squeeze us and compare us with landed duty-free price points that they get from other regions. That can only be set off once the European FTA kicks in somewhere in 2027. Once that happens, European margins will also improve.
Okay. Thank you, sir. Thank you.
Sure.
Thank you. A reminder to all the participants, we request you to kindly limit your questions to 2 per participant. If you have a follow-up question, please rejoin the queue again. We have the next question from the line of Ashutosh Nemani from JM Financial Family Office. Please go ahead.
Yeah, thanks for the opportunity, sir. My first question is, could you please walk through the BRFL acquisition, like by when it will be fully integrated, and how much do we currently hold it, and how much we have to spend more in the expected cash outflow?
So the BRFL business, if all goes as planned, it should happen sometime in the second quarter of next financial year. The exact timing cannot be stated here because it depends on the NCLT process and the regulatory process. So as and when it happens, it will. Our expectation is that it should happen sometime in Q2 of FY27. As far as BRFL's performance goes, I think we have been making, we have been investing in that entity through OCDs and extending support by buying, fabric from them and connecting them to customers, etc. But we have been, seeing some business traction growth for BRFL. There has been a continuous improvement in its performance. So far, I think we have invested in OCD to the extent of about 175 crores in BRFL. We've also bought 19% stake in the company, paying about 72 crores. The rest of the stake, equity stake, will be bought as and when the regulatory approvals come in Q2 of next financial year. And the business will get consolidated as and when that happens.
Yeah. Thanks, sir. And second question is regarding your capacity expansion plan. Out of the 105 crore plan for FY26 new capacity, could you please tell where is this deployed and what are the timelines, and how ramp up of this would impact our margin profile going forward?
So there are 2 units in India. One in Bhopal. The second unit is coming up. The second phase is coming up. The other unit in we have, as I explained, we have invested in the capacity expansion in Bhopal, the second unit, as well as one more unit in Karnataka. These 2 are in advanced stages of execution completion, and we expect the commercial production to happen the next financial year. Apart from that, we have expanded the capacity in Kenya. That's a substantial portion. We are also expanding with the new machineries and bringing up another unit additionally in the existing premises itself. That will also come on stream in the next financial year, in Q1 FY27.
Sir, and the second part of the question, how it would impact the margin profile, like the ramp up usually, what we have seen historically, whenever there's a ramp up, there is a margin impact we face. So what we will anticipate?
Most of the ramp up related challenges have already been absorbed. As currently the expansions are all happening in the units where we have operations. So we don't anticipate a significant margin setback on account of this.
Okay, yeah. Thanks a lot. I'll join back with you.
Yes, please.
Thank you. We have the next question from the line of Ankit from Anand Rathi Limited. Please go ahead.
Hello. Yeah, am I audible?
You are. Thank you, Ankit.
Yeah, thank you for taking up my question. So, I want to be a little bit negative on this side that if trade layer does not happen, so how it will impact our top line, Hazel's margin, and will we take a price hike, and what's our strategy going ahead?
If you are saying if the tariff doesn't correct, is that the question?
Yeah, it does not happen, yeah.
If the penal tariff does not get corrected, right? So see, we are working on that assumption, right? Unless there is a clarity on penal tariff, we have to work with the assumption that the Indian tariff will be 50%. And our order booking for Q4 and Q1 is on that basis. And we have already booked orders accordingly. So, and at the moment we are working on Q2 orders as well, which is also going in the right direction. So from a order booking standpoint, we are not seeing so much of challenges. We are, pursuing as much business growth as possible, and trying to keep our factories full. Having said that, the margins will stay impacted until the penal tariff is in place on account of the tariff-related discount that we may still have to extend to American customers. I don't see any ability for us to increase prices in the interim. With high tariffs, as well as the expectation of inflation in US, etc., our ability to increase prices is next to zero. So we will have to continue to seek ways to improve margins by operational improvements, supply chain related cost savings, as well as continue to book business by giving tariff-related burden share or tariff-related discounts.
Okay. And if we are diversifying our US operation to Europe as well as European Union, so how it has performed like in last 6-7 months?
So our European revenue is constantly increasing, quarter on quarter. We were at about 13%. Now, we are further increasing it going forward. We'll be about 16-17%. So we are in the, we are constantly increasing our European business going forward. That journey will continue for us as we progress. We will be adding also European customers, so that this is the way we will combat it. The other thing is we are also looking at pushing more American business into Kenya, where there is a duty advantage, and that region will also possibly grow faster with American business.
Okay. And AGOA, there is likely chance being extended. So when there will be a clear idea about that?
So it's going through the U.S. Congress. My sense is we will get to know within a month as to the status of AGOA. Month of February, we will have a clarity.
Okay. Thank you. Thank you so much. That's it.
Thank you.
Thank you. A reminder to all the participants, we request you to kindly limit your questions to 2 per participant. If you have a follow-up question, please rejoin the queue again. We have the next question from the line of Samay Sabnis from Helios Capital. Please go ahead.
Yeah, good afternoon. Thanks for the opportunity. So my question is, so you just mentioned that despite the discounts that were given in Q3, your gross margins have improved because the benefits of like Indian-based fabric that was used and strong negotiations that were done with the fabric suppliers. So I just want to understand, is this benefit like a one-off that will go in Q3 or could we see this benefit in Q4 as well? So basically, I want to understand the trend of the gross margin. Do we expect it?
Sorry to interrupt in between, Samay. I would request you to kindly use the handset mode to ask the question.
Hello, am I audible now?
Yes.
Yeah, you're much better now. Yes, you are, Sanjay.
The line for Mr. Samay has been disconnected. We will take the next participant.
Answer his question because I got his question. Unless, if he's still online, I wouldn't mind answering it.
Sure, sir.
So the gross margin is also a function of product mix, and product mix in Q3 and Q4 favors India. So we usually have a little better gross margin during this period. Having said that, we will continue to seek gross margin improvements wherever possible. It will be possible through better negotiations with the supply chain, better product mix that suit our margins, gross margins, etc. And we'll continue to seek it. Would there be a further gross margin improvement in the quarters ahead? It's not that easy. We will continue our endeavor, but it's going to be difficult to further improve it. We will keep trying.
Samay, your line is unmuted. Please go ahead with your question.
Yeah, so what I was saying is, the gross margins in Q3, you mentioned that despite the discounts given in Q3, they improved because the benefits of Indian fabric that was used as well as strong negotiations that were did with the fabric suppliers. So what I want to understand is, was this benefit like a one-time that you all had in Q3, or do you see this benefit in Q4 as well? So basically, I want to understand, will the gross margins improve in Q4 or they like remain steady?
See, again, as I said, the vendor negotiations have happened in Q3, and that benefit will continue as long as the tariff related pressure remains on us. So will the gross margin improve in the quarters ahead, or how will the gross margin change? I think it will remain steady at on account of all the purchasing related benefits that we have driven in, as long as the US tariff continues. But it will vary based on the product mix. Product mix to product mix, there are some gross margin variations that we will see. For now, I think the product mix, we're always trying to optimize the product mix so that we can drive up our gross margins. When we get into Q1 and Q2, the profile may slightly change because we switch to autumn winter wear, where the gross margin profile is slightly different, and the fabric becomes more imported, so there will be a little higher cost of fabric that we will incur, so their gross margins may drop. But during those times, we get a better realization from cost of manufacturing. So we tend to retain our EBITDA margin nevertheless. So there are nuances in the business which sometimes swings between gross margin to cost of manufacturing. Effectively, we tend to protect our EBITDA margins all the time. Coming back to your specific question on is there any one-time benefit that we got? The only one-time benefit we got was our negotiations with supply chain as far as raw material is concerned, which is linked to U.S. tariffs staying high. So as long as that remains, that benefit will continue as well.
Okay, thank you for this. That was really helpful.
Thank you. We have the next question from the line of Prerna Jhunjhunwala from Elara Securities. Please go ahead.
Thank you for the opportunity, sir, and congratulations on a resilient set of numbers. Just wanted to understand your revenue and profitability between standalone Africa and Matrix businesses.
The EBITDA margin from Atraco is about 1.5%, and then between Matrix and the India operations is more or less in the same range.
Sorry, sir, I didn't get your number.
EBITDA margin from Atraco is 1.5%, 1.5%, while the EBITDA margin for the India operations remains the same level at average.
Okay.
Yes.
Okay. So you said 1.5% in Africa?
Correct. For this quarter, yes.
Okay. And what would that be for 9 months?
I'll let you know.
So, sir, why is this so low for Africa and with the AGOA agreement?
Because the business volumes went down in Africa, we were unwilling to extend discounts in Africa to offset the loss of AGOA. These decisions were taken in January, February of 2025 because we tend to book orders for Africa well in advance, and we could see that AGOA could be allowed to expire by the current administration, and we were not willing to hold on to the business just by giving discounts. We wanted to also take some business corrections. Most of that is done, and as I said, once the volume kicks back in, and in Africa we tend to do over 25 million a quarter. So once that kind of volume kicks back in to Africa, which will happen from Q4, we will see a surge in EBITDA margin because the fixed cost gets amortized over a bigger business volume. So EBITDA margins will swing back from the fourth quarter onwards.
And the 9 months period, we did a break even, hardly about a crore loss. But we did good numbers in Q1, but Q2 was the real impact, big impact we have taken.
Understood, sir. So, sir, how do we see the margins going forward in India and Africa businesses, and how are you treating, the Europe orders, whether it is more from India or from Africa right now?
So my India business, if the reciprocal tariff remains at 50%, the India business margins will remain where they are. We will continue to seek improvements on the margin side by improving operational efficiencies. But that's only how the margin improvement may happen. But in Africa, we could probably see a good improvement. I am expecting Africa's EBITDA margin for next financial year, that is FY27, go by the second half of that year, cross 10% easily, maybe even stay at an average of about 10% in 27, based on the order volumes that we anticipate.
Understood. So, sir, if your Africa business is 1.5, that means your India business would be more than 10% in this quarter.
Yes, Prita.
Yeah.
Okay.
Understood, sir. Yeah. Okay. Thank you so much, sir, and all the best.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address all the questions from the participants in the question queue, we request you to kindly limit your questions to 2 per participant. If you have a follow-up question, please rejoin the queue again. We have the next question from the line of Harsh Mittal from Emkay Global. Please go ahead.
Yeah, thank you for the opportunity and congratulations to the management for a decent set of results despite the challenging environment. My first question, sir, is that UK FTA has been signed for the past 5 months. So how has been your interactions with your clients in UK, and do you see some uptick in business from the UK region? So that is my first question.
Okay. So UK FTA was signed in July 2025. However, we have not seen the benefit of FTA flow through. It is awaiting implementation. So at the moment, the exports to UK are still tariff rated, and we have not seen zero tariff benefit flow through as yet. So the challenge with such a situation is that businesses take commercial decisions. They would like to see a zero-rated tariff before moving significant volumes to India. Else, they tend to lose an opportunity of securing the tariff benefit. Moving the volumes from Bangladesh to India won't happen until the tariff regime actually kicks in. So directionally, many UK customers are talking to us, exploring stepping up the business volumes, etc. But the real benefit of all of that will happen once the UK FTA comes into effect. It is awaiting Parliament ratification. It is awaiting implementation. We are waiting to see how soon that will happen.
Sure, sir. So secondly, on the EU FTA, do you see any non-tariff barriers which may impact India, similar to what UK FTA is there in terms of compliance cost, product mix? Do you see the same thing?
So whatever non-tariff barriers exist even today, and we are able to address those. From a compliance standpoint, etc., we are very high up there compared to most Indian suppliers are. Whether it is an environmental compliance, social compliance, etc., we have, zero liquid discharge, zero hazardous chemicals discharge. We have renewable power in most of our factories. Our labor compliances are one of the best in the country, or best among the suppliers. So we don't see any non-tariff barriers impacting us impacting Gokaldas. From a actual tariff implementation perspective, that's the only one. So when European countries start importing at zero duty, which is when the implementation starts, maybe it will happen sometime in 2027, we will start seeing a good amount of business flow coming to India. In the meanwhile, we have to seek business by continuing to have tariff disadvantage vis-a-vis Bangladesh, Sri Lanka, or other regions, and we are still getting that kind of business growth from Europe. It will accelerate once the FTA comes into effect.
Yes, sir. So one question more.
Sorry to interrupt in between, Harsh. I would request you to please rejoin the queue. Thank you very much. Thank you. We have the next question from the line of Bhavin Chheda from Enam Holdings. Please go ahead.
Yeah, sir. Congratulations on maintaining good numbers in a very difficult environment. So a couple of questions. Main, as you said, sir, your order book, you must have already filled up for this quarter, as well as you're saying for next year, first and second quarter also, mainly US clients. So what my question was, I understand the tariff is implemented when the goods land in US. So whenever there is a reversal of a tariff, any goods landing there after that date, the incremental benefits start coming to us, because I believe there is a three-way sharing. Clients are sharing some part of the tariff, you are sharing some part of the tariff. So whenever that reverse goes, we don't wait till next order and the reversal starts coming from that day onwards.
Good question. Just to clarify, we have secured business until Q1. Q2 is work in progress, and so far it's directionally going well. As far as the penal tariff and the tariff-related burden share, it will reverse the day the penal tariff goes away. So that incremental 25%, if it is reversed, then we will have, our discounts being adjusted from the next shipment onwards, and not necessarily from the next new orders that we book.
No, my question was, so basically it happens even if your shipment has gone from India, normally it's a 20-25 day cycle. So even when it lands in US, that benefit starts coming in, right?
Yes, it will. So if our customer is able to take the goods at less than 50% tariff, let's say the penal tariff of 25% goes away on a certain date, 1st of May. Then any goods which they are able to clear customs in US at 25%, not 50%, our tariff for those, our burden share stops from those shipments onwards.
Sure. So my second question I understand is tariff is on incremental portion over raw material and any goods which are imported from US. So in any part of your business overall, you have imports from US where already you are getting some benefit, or there isn't much imports from US into your company?
Yes, of course. So if I use US cotton, for instance, as long as the component of US source is greater than or equal to 20%, we can get a set off for that amount in the reciprocal tariff. So we are using US cotton as much as possible in our raw materials, because we can get that 50% offset on US-based raw materials. So we are using all those tools available at our disposal to minimize or reduce the burden.
Have you maximized it, or this keeps on increasing US cotton imports every quarter?
This is a function of product mix. Wherever we are able to use US cotton, we will.
How much percentage of cotton is US cotton right now in your portfolio?
Yes. So there are, I think we should have about closer to 25% of the FOB, in cotton-based garments as US cotton.
Yeah. And sir, my last question, sorry, the third one.
What will happen in the first quarter is that we will be switching more to synthetics. So that is when some of these benefits may come down, because then we will be using synthetic fabric from the Far East.
Sure. And my last question, sir, as UK, it would be signed anytime, but the announcement happened a year back, and India EU announcement has just happened. So just taking example from UK announcement which happened last year, I'm sure you would be seeding that market, because whenever the parliamentary approval comes, directly benefits on margins and overall business comes in. So obviously the players will seed the market much ahead of actual tariff implementation. Can you give some example of how UK business has been performing, and how many clients you must have added in the last 1 year or so, and how experience has been from the announcement till date in the UK market? Because I believe the similar pattern will follow in the India EU also.
Right. UK is a much smaller market compared to EU, and we have 3 customers from UK that we are supplying to. We are seeing fair amount of growth in the revenue from these customers. However, at the moment, the growth is coming without any tariff-related benefit accruing to the customer or to us. So the growth will get expedited once the tariff kicks in. Until then, it's about onboarding a customer and preparing ourselves for a duty-free future. As and when that kicks in, that's when the real transaction will happen. See, customers are also commercially oriented. They would prefer to get zero duty. If they get zero duty imports from Bangladesh and it is still charged from India, they will not move significant volumes. There will be, testing, preparing the grounds, etc., which has all happened. Now we are waiting for the actual tariff to get re-rated before real volumes will flow.
Okay, thank you, sir. Yeah, thank you.
Thank you. A reminder to all the participants, we request you to kindly limit your questions to 2 per participant in order to ensure that the management will be able to address all the questions from the participants in the question queue. We have the next question from the line of Varun Gujaria from Omkara Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. Congratulations on a good set. Sorry. Yeah. I just wanted to understand, we have seen some media commotion on Bangladesh facing some kind of internal crisis, and also the factory shutting down probably in February. Is there any substance to this? And if there is, then what kind of impact are we seeing on overall supply chain? In terms of competition.
In Bangladesh, the production volumes from Bangladesh has not really fallen. So factories are working, and factories are continuing to export from Bangladesh. So while there are some challenges brewing in that country on account of factor costs going up, on account of geopolitical situation, we have not yet seen an impact on Bangladesh till date. Having said all of this, brands with whom we keep having conversations are also concerned about how the elections will play out, what kind of situation will be there on the ground. Now that visas for Indians are also restricted in Bangladesh, movement of people between these two countries have become a challenge. So a lot of brand people also are not able to visit. So some of these challenges are becoming significant from a ease of doing business perspective. This may have some impact going forward. We will also have to see how elections play out in Bangladesh and how the factory operations are, whether they are impacted or not. It really needs to play out in the next few months.
Okay. And the 60 crore impact, net 45 crore impact, is this the stable state tariff impact that we are expecting as long as the US tariff stays?
Yes.
Okay. Okay. And in terms of European Union, if it's the FTA, whenever the FTA comes on board, what is the opportunity size for our company, considering the products we are in?
When the European FTA kicks in?
Yeah.
So that it's a very significant opportunity. It is an immense opportunity, I would say. Europe buys about 75-80 billion of goods, and once we get a zero tariff from India, that's a very large opportunity, even though European retail is more fragmented than US is. So we would see a lot more volumes move to India once that happens. Of course, these things take time to build up, and I would anticipate that European FTA, by the time it kicks in itself, will be a year and a half. I would think that the opportunity scale can be massive.
Okay. And sorry, sir, earlier I did not really get the number on the margins in India and in Africa. If you could just spell that out once more.
Africa in Q3 is 1.5%.
The expectation.
In Q3, it is 1.3.
Expectation. Yeah.
Talk about expectations.
You're talking of expectations?
Yeah.
So Africa for next financial year, we are anticipating, at least in the second half, going to 10%. In the first half, staying at between 7 and 8% EBITDA margin. Our endeavor will be to see if we can get there faster, but that's the expectation going forward.
Okay. So 1.5% to 7.5 to 10%.
Sorry to interrupt in between, Varun. I would request you to kindly rejoin the queue again, as there are participants waiting for their turn.
So let let me just answer that question. That improvement will happen primarily because, the order book is going to swell, and that itself results in better capacity utilization. See, in the immediate wake of AGOA, pull-out, we did not deliberately step in with, business discounts, etc., primarily because the African margins were also low, and we really did not want to go down that path. We were reasonably confident that AGOA will get restored, and we did not want to participate with discounts and then get into, a long-term margin decline kind of situation in Africa. So we took a conscious decision not to go down that path there, while in India we did take a conscious decision to quickly participate in tariff-related discounts to hold the business in India. So in Africa, we saw a business dip in Q3 and Q2, which is where we got impacted on account of fixed costs, which will get reversed starting Q4.
And India margins stay at 8% currently?
India margins will stay where they are until the US tariff remains.
Okay, thank you.
Thank you.
A reminder to all the participants, we request you to kindly limit your questions to 2 per participant. If you have a follow-up question, please rejoin the queue again. We have the next question from the line of Jay Shah from OHM Portfolio Equity Research. Please go ahead.
Hello, am I audible?
Yes, sir, you're audible.
Thanks for the opportunity. My question again is related to the tariffs and the sharing of the tariff burden. How does rupee depreciation play out here, since we have seen a very aggressive rupee depreciation against the euro as well, and GBP in the last 6 months besides US dollars? That is, and the related question here is that if I look at the sharing formula that you've been talking about, is my thinking correct that your US business is in very low single-digit EBITDA, while Europe actually could be higher than double-digit for overall company balance, company EBITDA to come at around 9%? Thanks.
Yes, you're right. And in terms of currency, we hedge our receivables. So while the currency may have depreciated sharply to about 91 rupees to a US dollar, our realized currency will be a lot different depending on what we hedge. So currently we have, our hedge rate for Q3 was about 88.5 or thereabouts. So, that prevents us from currency volatility in either direction. At the moment, we are at the receiving end of currency volatility. If we had not hedged, it would have helped us. But we play a very prudent. We adopt a very prudent currency policy and hedge all our receivables for the next 2 quarters, and most of the receivables for third and fourth quarter at any point in time. So we have a 1-year forward cover program that we closely implement. So from a currency standpoint, eventually the benefits will come through. Customers will also this is transparent. Customers will also come in and try to take advantage of the situation. Otherwise, the competition may end up giving some bit of it. As long as the steep US tariff remains, maybe since we are bearing a significant burden, we may tend to hold on to some of those currency-related benefits for now, but eventually, in the longer run, those do get shared.
Thank you very much. And a related thing is, as and when the penal tariffs come down, is there a waterfall where the suppliers will get the first benefit and then you would get the benefit in terms of sharing of the penal tariff burden?
No. So penal tariff, as soon as the penal tariff is brought down, the benefit has to flow through the supply chain. So we will from the orders that do not get impacted by penal tariffs, we will save the discounts, and our supply chain also, we will tend to, give them the benefit of that. While we are imposing certain costs on our supply chain, that also will be taken off from that point.
Thank you very much and best wishes.
Thank you. We have the next question from the line of Sahil Sharma from Dalmus Capital Management. Please go ahead.
Hi. Thank you so much. So on the Africa business, I just wanted to understand that we develop a tariff advantage over other Asian counterparts. There's a related logistic cost with respect to raw material availability, etc. So if we consider all these factors, how does Africa stack up against countries like Bangladesh, Vietnam, with and without AGOA?
So today Africa has a 10% tariff delta with Bangladesh. The reciprocal tariff in Africa is 10%, Bangladesh is 20%, right? Now, if AGOA is restored, if you look at cotton garments, the average duty is about 18%, and if you look at synthetics, it's about 28%. So if AGOA is restored, the underlying duty gets rated to zero. So then for cotton garments at 18 plus 10, 20, the delta will be 28%, and for synthetic garments, it will be 28 plus 10, 38% delta vis-a-vis Bangladesh. That is when Africa's power comes to play if AGOA gets restored. At the moment, we do not have the AGOA benefit, which means the delta vis-a-vis Bangladesh is 10%. Does that clarify?
Yeah, understood. If, say, the penal tariffs go away, so would we still continue on the strategy of diversifying customers' supply base, or would we, more comfortable with the US-focused operations that we have currently?
No, if the penal tariff goes away, we will be very comfortable doing US business. US retailers are large. US retailers are, have longer run sizes, which allows us to operate efficiently. And it's a very good market. It's a high consumption market. So we would be very keen on, continuing our US business. And, we have very good relationships with US-based customers. So that goes without saying that US will become a dominant buyer from us if penal tariffs go away.
Okay. So it's like if the penal tariffs go away, so we'll continue with this strategy of, focusing on the US and
right. But keep in mind that having seen tariff volatility, diversification will continue to remain a thesis for us. But that doesn't mean that we will pivot out of US. We will take on more of Europe. And if European business gets FTA benefit, we will see a lot more growth happening on European side. So the portfolio may get rebalanced a bit, for sure. But that, wouldn't mean that we will, significantly reduce our exposure to US. If the penal tariff goes away, US will also have its reasonable share in the business.
Understood. Thank you.
Yes.
A reminder to all the participants, we request you to kindly limit your questions to 2 per participant. If you have a follow-up question, please rejoin the queue again. We have the next question from the line of Raman KV from Sequent Investments. Please go ahead.
Hello, sir. Can you hear me?
Yes.
So, I just have one doubt with respect to the African operations. So given that you are confident that 25 million quarterly volumes will come from Q4 with respect to the African business, if we shift majority of our US shipment to Africa, our tariff burden will also reduce, as well as the African business will ramp up, which will help in getting 10% margin from African business. Is my understanding right?
No, it is not. Because, Africa also has capacity constraints. Our endeavor is for next financial year, try to push African revenues to 120, 125 million or thereabouts next financial year. And India's revenues are much higher than that. So we cannot move garment or reroute it through Africa. Whatever is produced in India will get tariffed based on the tariff applicable for India. And whatever is produced in Africa will get tariffed based on that region. So, the amount of orders that we can ship from India to Africa will depend on how much capacities we have there. And we will tend to maximize that going forward. But since Indian volumes are pretty significant, close to about $350 to $375 million, and of which about 70% is to the US, we will continue to see that tariff being impacted here. We cannot reroute it to Africa. That is not an option.
No, I didn't mean reroute it, but just to increase the capacity in the African entity and then try to, bring down the orders from India to USA and replace those from African entity. That was my question.
Yeah. So at the moment, our aim will be to push as much business from India to Africa, fill more India with European business as far as possible. We don't intend dropping India volumes at all, and grow our revenues from Africa. That's the plan going forward. And we may be able to bring on board going forward.
Understood, sir. And so, just a last question. With respect to Indian entity, what is the total capacity in India, and how much is the current utilization?
Our current utilization is in Q3 and all, it is full. The manpower and machine power capacity, it's almost going full. So at the current run rate in Indian operation, we should be able to do around the top line in the range of 750 to 800 crores. This is without considering the new capacity which are coming on board.
And the volume figure, sir? Like, what's the quarterly volume from Indian entity? Approx?
Sorry. The current capacity in India is around 850 crores.
Yeah. And I think we will be able to add more because we have one more factory in Bhopal and an underutilized factory in Karnataka, which will, and plus the unit in Jharkhand. So I think Indian capacity can be increased, in my opinion, by another 200 odd crores further from where we are. We have not fully allowed that those capacities to be staffed with people, looking at how the tariff is playing out. And we wanted to see if we can get more European business or the right kind of business to expand. But I still see with the kind of capex that we have done in the past, we should be able to push up additional revenue annually to the extent of about 200 odd crores.
And how much this Bhopal, Jharkhand and Karnataka additional volume comes from these three entities?
No. So these three entities put together can contribute about 500 crores annually. Having said that, we are already utilizing a portion of those capacity, but very small, and we will probably ramp up by another 200 odd crores going forward. But the real test for that will be how the tariff plays out, when will the European FTA kicks in. That is when some of these capacities we will tend to start utilizing more of. At the moment, we have not started ramping up people there while the factories have been built out, because these decisions were taken pre-penal tariff, and once penal tariff has come on board, we are going slow on some of these capacity, onboarding these capacities. As I said, we will have the potential to up our revenue annually by about 500 crores, but we will wait for the right timing before we bring the necessary staffing and ramping up the capacities decision is taken place.
Understood, sir. Thank you.
Thank you. A reminder to all the participants, we request you to kindly limit your questions to 2 per participant. If you have a follow-up question, please rejoin the queue again. We have the next question from the line of Neeraj from White Pine Investment Management. Please go ahead.
So just wanted to clarify again, thank you for the opportunity, that you have a run rate of almost 2,600 crores on the standalone entity, on the India side. So how much can that, or is it fully utilized, or is how much that can, what's the revenue capacity, the right way to put it? How much, if you run full, what can be the revenues for the entity? Hello? Hello?
Sorry, as I said, the additional revenue that we can drive from India is to the extent of 500 crores. We do have the physical capacity. We have not really put in the workers there because we want to wait and watch as to how the tariff situation unfolds and when the European FTA and all kicks in, right? So we will have to build up that volume for this additional incremental capacities that we have available at our disposal, but we have not ramped up the people there. So we will be doing it. Since these factories are already in the region where we are operational, our ramp-up costs will not be high. We will be able to ramp them up faster. So when we ramped up Bhopal first unit, it took us 2 years before we started breaking even and contributing to profits. But the newer units will probably start contributing much faster, given that we have an installed base in all these regions. We have primed ourselves up for all of those. Having said that, this incremental 500 crores, I don't think will happen soon. As getting additional business at these kind of tariffs will take time. We may also be cautious in building up additional revenues in these times. We will wait and see how all of these unfold in the quarters, in the months ahead.
And so on the Atraco side, including 4 of Kenya and 1 of Ethiopia, you said 150 million is the revenue potential from that. What is the current run rate of revenue?
120 to 125.
Okay. And what is the current revenue right now?
Current revenue, we will be at around 90 to 100 crores. 100 million, sorry.
90 to 100 million. And so last question, on the margins of India, can you just put the numbers, please? I think if you remove the Atraco margin, how much will be the margins from India manufacturing?
We are around 10% level in India, the operation margin level.
And is there a breakup you can give on how much percentage you would get on exports to Europe higher versus Europe versus US? Is there a breakup you can give?
Africa operation is only 1.5%. The remaining amount you can really arrive at it. That is the India operation.
No, so I'm asking from India, if you're exporting to US or Europe, what is the difference in the margin today?
Oh, US, Europe. So US margins will be in the low single digits, post-tariff discounts. Whereas European margins are in the region of about 11, 12.5% or thereabouts.
And you see further scope of increase in the Europe, right?
So our aim is to increase the European business. We will continue to endeavor doing that. The question is how do we rationalize the capacity between US and Europe, and what is the timing up to which this penal tariff will remain. So we'll have to, take a balanced call on some of these. We also have booked revenue from our US customers all the way to Q1 and including Q2. So we'll have to balance all of these, capacities. So some of these capacity allocations will unfold in the quarters ahead. We cannot pivot in the short run as we do book orders well in advance.
Thank you. We have the next question from the line of Saurabh Srivastava from Arista Consulting. Please go ahead.
Good morning, sir. Sir, am I audible?
You are.
So just now you said that the European and this India FTA deal is going to be a great opportunity. My first question is that how do you plan to navigate it? And you will be taking some leased out facilities or will be expanding. And second question is regarding the African operation. Africa sits in a very sweet spot given this tariff structure. So how do you plan to expand there? especially vis-a-vis the US business? And third, if you can give me some idea about the US and the European mix going forward vis-a-vis the customer base.
So if European business comes, we will have incremental capacity in our system itself. So we will onboard some new factories and take on additional European business. So we are not going to cannibalize US business at all. In fact, those capacities are given, and we will continue to hold on to our US business. So as far as Africa is concerned, while most of the business in Africa are American, we are also onboarding some European clients now, as Africa goes duty-free to Europe as well. So that's hitherto we did not have European customers there, but for now we are actually adding European customers into Africa as well. So that's an incremental opportunity that we're looking at in Africa. As far as the US-Africa mix is concerned, today European business is closer to about 15, 16% of our total revenues. Intention is to take it up to 20, 25, but these things do take time. These things take several quarters before the percentage of the revenue for Europe gets built up. Keep in mind that, either for UK or for Europe, we still don't have a zero-rated tariff. We're paying full tariff. We, unlike Bangladesh, Vietnam, Sri Lanka, Pakistan, and all these other competing countries, enter Europe with zero tariff. So some of those European growth, while it is happening, will only get accelerated, or the ratios will get rebalanced only when actually these FTAs kick in with its zero-rated tariff.
And there has been some GST withdrawal from European Union vis-a-vis Indian operation as well as the key Indian one. Will it have some impact?
Oh, that's 20% or 12%. That's 2.4%. That is operating in the margins. That's barely. It doesn't make an impact at the moment.
Thank you, sir. Thank you.
Thank you. We have the next question from the line of Gunjan Kabra from Niveshaay. Please go ahead.
Hi, Subhash. Thank you so much for the opportunity and always a great insight on the sector and how the company is moving towards those dynamics. So one thing which I wanted to understand is that since the tariff has been imposed since long now, and it's not in our hands that when the resolution will come in. So and for the brands also, the inventory was also on the lower side. So when you talk to the players in the US and the brands in the US, basically, then is there an inclination towards supply chain shift? I know it takes a lot of time, but is there an inclination towards that we should shift the supply chain a bit?
See, if the high tariff continues on India, right, then anything is possible, right? If at 50% tariff, it's like everybody is bearing a pain. The supplier is bearing the pain, the buyer or the retailer is bearing the pain. So if 50% tariff remains for the long run, then, there will be concerns. We're hoping that some resolution can be found, or, people like us will give some options of part sourcing from other countries so that we can bring the tariff burden on our customers. But India operations, if 50% tariff doesn't change soon, change in the next several months, we may have brands looking at options to diversify their sourcing. So these are early days. We don't exactly know how brands are thinking because they are also finding it difficult to onboard capable suppliers in other regions. So they are continuing to buy from India. We are continuing to explore how we can support them and minimize their tariff burden. So all of those are going on. But as I said, these things will play out in the next several quarters, depending on how the tariff regime unfolds.
Got it. And with respect to the EU FTA, I mean, the opportunity size is very large and it's huge, that's there. But considering the players that are already there in the EU market, like how the brands are sourcing from Bangladesh or Vietnam, so that share is also pretty huge. So basically for us as a country, how how easy it is for us to, compete in that market once the tariff is also resolved. So how are the brands thinking in terms of, sourcing from India and not from other countries? And how is the onboarding cycle of customers in the EU, considering the market is very fragmented and small order sizes?
Okay. No, so most Europeans are buying a lot from Bangladesh. They are seeing geopolitical concerns in Bangladesh on one hand. They're also seeing an advantage of buying from India, given that prospectively our tariffs will go down. So many of them are actively present in India, trying to onboard suppliers in India, looking at options to buy from India, even for retailers who are hitherto not buying from India, buying only from Bangladesh and other duty-free regions. So there are a lot of retailers who are now actively considering India. So that's the good news, and that will play out incrementally going forward as India-EU FTA comes to fruition.
Okay.
Thank you.
And just to order,
Gunjan, I
to order
request you to
size.
join back the queue, please, as we have other participants.
Thank you so
waiting for
much.
their turn. Thank you. Ladies and gentlemen, in order to ensure that management is able to answer queries from all participants, kindly restrict your questions to 2 at a time. You may join back the queue for follow-up questions. The next question is from the line of Bijal Shah from RTL Investments. Please go ahead.
Yeah, hi. Thank you very much, and congratulations on good set of numbers in challenging time. I have 2 questions. One is on margin and another is on Europe, diversification strategy. So first on margin, see, if I look at 40 crores of one-off, which is on account of tariff, and if I adjust for that, the India margin looks really, really good. It just goes about 13%. That we have not seen even in the years when there was no tariff, and we were running at a high capacity. So is there something I'm missing here or not? And secondly, within that when tariff goes away, can we really go to 13% kind of margin? That's for question 1. Question 2 is with respect to tariff. So tariff, despite tariff impact, so you have 25% disadvantage when it comes to US. Now, despite that, you are able to make some positive margins. In Europe, your disadvantage is much lesser. So why not think of onboarding Europe and UK clients starting now itself and give them the discount and ramp up the capacity utilization and improve overall EBITDA? Though margins would be lesser, but overall EBITDA can go up even if you give like 10-12% discount, because with 20% and 5% kind of discount, you are still making good positive margin in US. So these are the 2 questions.
Okay. So yes, adjusting for margins, the India margins are strong and will continue to remain. This is primarily because we have also unleashed a lot of operational improvements and some significant cost management here and efficiency management here. That's one of the reasons. As far as rebalancing US Europe, while that continues, some of these orders are booked in the long term. We also have strong relationship with customers. Our US customers are also persevering with us in the hope that the penal tariff will go away. So we don't also want to, reduce their business volumes, keeping a lot of short-term considerations in mind, and then hoping that once the penal tariff goes away, trying to build back the business. US businesses are generally a little more profitable than European, given business volumes. So we also have to balance some of these considerations when we look at the portfolio between US and European customers. We will walk that path very carefully. While we will expand European business, that's clearly an intent. We do not want to contract US business, as if the penal tariff is removed, we will see ourselves to be in an advantageous position with those US customers, and we don't want to lose that.
Thank you. We have the next question from the line of Shraddha Agarwal from Asian Market Securities. Please go ahead.
Yeah, hi. Sir, so congratulations on a great quarter despite difficult times. And two questions. First is, could you give the split between between US and Europe exports from India?
From India?
Yeah,
Okay.
from India.
US and Europe, only from India. Can you ask the next question while we, give you that answer?
It was a related question because to my understanding, US exports would be still at a higher number. And despite making low margin in the US exports from India, we are still at a blended 11-12% margin in India. So didn't get the math well here.
So from India, we are doing almost around 70%. 70% was the revenue from India.
And Europe?
Europe was the balance.
Yeah. So a pretty significant part, almost 17-18% will be Europe, but rest of non-US business will be at higher margins anyway.
Higher margins.
Yeah.
Yeah. So Europe is, you're saying, margin of 11-12%, and US margin is mid-single digit, and your India blended margin is 11-12%. It's 10%. So despite 70% of your business coming in at low single digit margin, how is India blended margin so high at 10%?
I'm sorry, India business is around 62% blended, because I have to include the other operation from Matrix also. Sorry about it. 62.
Yeah. 62% US.
62% is US, India operation.
Yeah. So, sir, the question still remains, right? 60% of the business operates at low single-digit margin. Even then, on a blended basis, we are getting 10%.
Yeah, correct. So when we say single-digit margin, when I look at EBITDA margin for US, it is in the order of how much? 6-7%. 6-7% for US, and European margin or non-US margins have actually kicked up because of the cost efficiencies that we drove. So that is at a blended region of about 13.5 or thereabouts. Right. So that gives you the average, whatever average you have.
Got it. And so just another clarification. So you mentioned that you could negotiate with your vendors because you had a higher proportion of India-based raw material in the product this time. And I think on one of the questions, you also mentioned that you had a higher proportion of US imported cotton, which might come off in the next season when you have a higher portion of synthetic, which will be supplied from Far East. So, I mean, was it more of India-based raw material or was it more of US-based content, and how do we see margins then progressing from here on?
So when again, when we look at Q1 onwards, when there will be possibly, we have to look at the supply chain, and I'll relook at what is the US component in the supply chain, but we may not have as much of US cotton in Q1. We may see some amount of tariff burden slightly increasing on that count. It may not impact margins much. It may affect us at about 1%, 1.5%. But my sense is we will continue to look for ways to improve our margins in terms of either operating efficiency or supply chain sourcing. How does that, how much of that we push back to our suppliers? All of that will have to play out. We will try to protect our margins as far as possible in that period.
Thank you. We have the next question from the line of Nitin Bharat Shah, an individual investor. Please go ahead.
Yeah, hello. Am I audible?
You are.
Yes. Okay. So the first question I would like to ask is, I presume the US customers would have reduced buying from us, or some of them would have stopped buying from us. In that case, where are they buying from? Oh,
no,
okay.
They have not. They have not. They have continued to buy from us.
None of them, right?
Correct.
And does the present numbers include the labor code cost?
Yes.
Okay, that's all. Thanks a lot.
Thank you. We have the next question from the line of Bharat Agnihotri, an individual investor. Please go ahead.
Hi, am I audible?
Yes.
So my question is, so there's some examination that the U.S. Supreme Court is making on the legality of these tariffs, and they might pronounce the result this month. So is there a possibility that your customers get back the tariffs that they have paid? And since most of the tariff has been absorbed by the company, is there a possibility that they pass on that the recoup tariff from the U.S. government to you in the form of additional income?
It's a very good question. At the moment, it looks unlikely because they have also borne the cost of all those litigations, etc. And that's a refund at risk. It's highly unlikely that benefit will accrue down to the supply chain. So it will be unfortunate, but our retailers will get a windfall gain if that happens.
Okay. And my second question is on the India business. When I say India business, I mean like you selling to customers in India. Like, what's the volume on that? And is there a strategy to improve the volumes and the geography?
At the moment, when we look at India business, it's largely to the international brands operating out of India that we supply. We do not cater to domestic Indian customers at all. What is the strategy for India-based revenue? At the moment, we're not pursuing India retail as an option. We want to see how the US tariff plays out, how the European and UK tariff plays out, because that brings in a new opportunity. We find margins supplying to India retail is low, given that we will be competing with a lot of smaller retailers, smaller suppliers, whose compliance costs and all of those will be a lot less. So we're not focusing on India retail at the moment.
Thank you. We have the next question from the line of Manju Bhasini from Ask Wealth Advisory. Please go ahead.
Hello. Greetings to the management. Am I audible?
You are.
Yeah. So just one question on the yesterday's budget announcement. Are there any changes on the export incentive schemes that have come through in the budget, and anything that you would like to explain to us on that?
So there are no changes to the scheme. However, the allocation to ROSCTL and duty drawback has reduced compared to the actual spend in 2025-26. So I don't know how that's going to play out. Unless the budget allocation is increased going forward, we may find we are finding actually that the export incentives that we get and the budget allocated for that seems to have changed. But in terms of actual pronouncements, we have not seen any change. So we'll have to see how that unfolds.
Even in the past, we observed that the allocation at the budget level was lower, and then subsequently it was corrected. We hope that it will be done that similar way. Otherwise, we don't have any specific information at this point of time.
Okay, sure, sir. Thank you very much. Yeah.
Thank you. We have the next question from the line of Harsh Mittal from Emkay Global. Please go ahead.
So thank you for the follow-up. So just one question. In the starting of your call, you have mentioned that there has been a lot of cost efficiencies which has led to the margin expansion or the improvement. So do you see any further cost efficiency or headroom left for the FY27?
So some of the efficiencies may come from a depreciated rupee, right? We normally don't take currency benefits to our advantage when we look at internal EBITDA margins, etc., at a customer level. So, some of that can also help us. As I said, since we hedge, and currently our hedge rates for USD receivables is close to 88.5 or 89, and while the real currency is operating at closer to 91, there may be some upside sitting there. But it also gets, eventually competed out in the longer run, but in the shorter run, we may see some upside. Any product portfolio, product mix change, etc., can also have a negative effect. So, these two all of these do tend to sometimes cancel off each other, but there is a small upside in terms of currency sitting there. We'll have to see how that actually plays. I wouldn't go and take that benefit much, as eventually these do get leveled out.
Sure. Thank you.
Yeah.
Thank you. A reminder to all the participants, we request you to kindly limit your questions to one per participant. We have the next question from the line of Ritesh Gandhi from Discover Cap Capital. Please go ahead.
Yeah, hi, sir. Just a question. Even if we lose the Russian extra tariffs that are there, the other tariffs also, India is it's an advantage compared to Bangladesh, Vietnam, Pakistan, Turkey, etc. So do we see any implications actually longer term, even if this is 25% goes away?
No, so
Even though it is 25%, India is higher. Are you saying India
is higher by 5%? You're saying that?
Yes.
No,
Yeah.
if India's tariff is 25% while Bangladesh is 20%, will that impact us? Answer is not much, because that's only a 5% delta. It may impact partially. We may have to give some degree of offset to customers for that 5%. But since we are currently, talking about a 50% versus 20% delta, that is not becoming a discussion point. But once the penal tariff goes away, that may come in as a discussion point, and maybe we'll have to, partially support the customers for that 5% delta. Will that impact business volumes much? Answer is no.
Got it. And the other question was that, when we look overall at our margins, historically, we haven't had really this extra 25% to really give back to the customers. Yet we are ending up being profitable. Just want to understand how that's actually playing out if we are passing on a lot of this. And specifically for the American orders, are they at break-even levels? Are we making a small amount? Are we losing? And how long can we actually, hold up and actually continue to subsidize the 25% penal tariff?
See, where the U.S. customers' EBITDA margins have come down primarily because of the tariff burden that we are sharing. Depending on the customer, the tariff burden shared is different, and we keep negotiating with our customers. We get some offsets from our suppliers as well, because some of that tariff burden, we in turn push it back to our supply chain. And then we get some credit on account of depreciating rupee. So we should not forget that. Internally, we don't consider rupee depreciation for our calculations, because that's an externality from our standpoint. But at a P&L level, it does play out, and we do get some offsets there. So our U.S. EBITDA margin, after factoring in some of those rupee depreciation benefits, also goes from low single digits to mid to high single digits, because that benefit also kicks in. But then these kind of situations do tend to benefit us for now. But when the tariff burden goes away, we will of course claw back on the burden share. But then the rupee depreciation might then come back for discussion on sharing with customers. So all of these will play out. Let it play out when it has to happen. There are too many moving parts in the business, some to our favor, some to our disadvantage, and what you see is the net result. What we can focus on is to ensure that we execute well. We try to drive out costs as much as possible, and which is in our control, and that's what we do.
And people look, yes, it does.
Sorry to interrupt in between, Ritesh. I would request you to rejoin the queue.
Okay, no problem.
Thank you. We have the next question from the line of Hitendra Pradhan from Maximal Capital. Please go ahead.
Hi, sir. Thanks for taking my question. So my question is related to the other income. So, sir, what does the other income constitute here?
Other income at the consolidated income level you are looking at, right? One is
Yeah.
one is the interest income, interest on the OCD what we have classified separately. Other than that, anything on the mutual fund investments and other investments what we are holding, that is the income what is shown there.
It doesn't take into account the currency impact and the...
So the currency impact and all is shown separately below the line, right? There is a forex impact, gain or loss on account of foreign exchange fluctuation we have shown separately.
Which is not part of our EBITDA margin, or it is part of our EBITDA margin that we reported?
It is part of the EBITDA margin.
Okay. Okay, sir. So, sir, if the tariff situation reverses, so we can expect that the US business to again generate say 12-13% of EBITDA margin from the current low single digit.
Yes.
And this is like the inventory. You made a comment earlier that the retailers are also not stocking up because the prices are elevated and or probably they are anticipating some kind of slowdown. So if you can give some clue to who are our customers, are they in the premium segment, mid premium, or value segment, and what are the demand scenarios at the US customer side?
So when you look at the aggregate macro data, if you look at the retail sales, retail sales for calendar 25, now we have data even till November, and we are seeing it go up a little above 4%, and US imports are down by 1%. So there is a delta there, right? If US retailers are importing less, even though the retail sales are going up, which clearly indicates that they are not allowing their inventory to build up, and on the contrary, they are allowing inventory destocking to happen. People are not wanting to buy at 20 to 50% reciprocal tariff regime, or are loath to build up inventory at these levels. They may be waiting for the Supreme Court order to see if there is a tariff reversal before they start coming back for buying more. So we'll have to see how this plays out. They may also be worried about how inflation plays up in the next calendar year, that is 2026, in which we are, and see how price increases, which will go into effect this year, will also impact U.S. retail demand. So basis that, they will probably start building up inventory. But for now, U.S. imports are trending below U.S. retail sales. And that's interesting to see, because then there is an incremental tightness in inventory that you will see happen in the U.S., which may reverse. Now, how does this play out at an individual retailer level? I think at the moment it's across all segments that we are seeing it, including mid-premium, premium to mass market. Mass market retailers are where bulk of them are. We will have to see, how they will play going forward. Mid-premium and above are actually trying to pass on more and more price increases back to their customers, whereas all the others are holding back as much as possible or passing on very marginal price increase to their customers. So it will depend on how their strategy plays out in spring 2026, which is yet to happen. The extended winter continues. US is seeing a brutal winter as we speak. So we'll have to see from spring 26 onwards how the retail market unfolds.
Okay, sir. Thank you, sir.
Yeah.
Thank you. We have the next question from the line of Sagar Makwana from Max Securities. Please go ahead.
Hello, sir. Good morning. So my first question is a little bit long term. As we scale our presence in EU and UK, so do we anticipate any shift in working capital days and margins? As you said, in Europe, they are higher. And also, sir, please correct me if I'm wrong. Since sportswear typically delivers higher margins, do we see any opportunity to meaningfully scale this segment to enhance overall margins over medium term, or this category likely to remain low and structurally dominated by China and Taiwan?
So to answer your second question, our European customer is sportswear dominant, and in fact, that is one of the reasons why we were able to expand our margins also. So we are continuing to push more sportswear related business to offset some of the margin challenges that we have. Are we pushing up European business keeping long term in mind? Absolutely. Given that FTA is coming into effect, etc., we are pushing that European business up, and we will continue to do that. Once US FTA, US penal tariff goes away, we will see some US business growth as well. So we're not wanting to let go that opportunity. We are continuing to engage with US as well. So in terms of customer portfolio perspective, we are calibrating it very closely. We are allowing European business to grow faster for now, given that there is a tariff benefit for us serving Europe. How are we looking at sportswear? We are looking at it favorably. We are trying to expand that business, and we are seeing good traction coming in from sportswear business. Even though the natural home for sportswear is Vietnam and those regions, we are seeing good amount of traction coming in that space for us.
Okay, sir. So, and my second question is, will ASP will get lower as we enter into knits and due to Atraco heavy casual wear?
Will what? CSV?
ASP, sir, average selling price.
It will not. What is it? Average selling price, will it get
ASP.
lower? Average selling price, will it get lower?
Yeah, if Atraco's growth happens at a faster rate than India, definitely ASP average selling price will come down. Yes.
Okay. And sir, my last question, sir, if this AGO get restored, sir, is there any duty refund we will get as in one-time gain?
If what gets restored?
AGOA.
Sir, AGOA.
AGOA. Oh, no. So all that will be prospective. I don't think we'll get a duty refund for past. Yeah.
Okay, sir. Thank you so much, sir. That's all from us.
Thank you. We have the next follow-up question from the line of Prerna Jhunjhunwala from Elara Securities. Please go ahead.
Thank you for the opportunity. I just wanted to understand, with so many cost control measures undertaken internally and externally, how do we see our sustainable margins once this US trade deal settles and we enter into high growth period wherein FTA with UK and Europe are also signed. So just wanted to understand how things will move and how do you see business?
So in the long run, there are many moving parts. One is trade deal, US tariff. At what level will it settle? Will it settle at 25? Will it remain at 50%? Will it come down to 25%? Will it come down to 20%, which is equivalent to other competing countries, right? And the margins will depend on all of that. So let's assume that the FTA, the penal tariff goes away, comes down to 25%. At that moment, US customers may come in and start negotiating on that 5% delta with other regions, which at the moment is being ignored given that the delta is so wide between 50 and 20. What will be our margins at that point in time? I'm sure we'll be in 12 to 13% India margin for all business, including US. Our advantage if we merge BTPL, which is the fabric unit, with us, will also help us nudge up our margins by a few percentage points because fabric will become internal. So that's another dynamic that we will see in the longer run. European business will probably also will also come in at good margins, primarily because in the longer run there will be a European FTA in place, so that will help. For the moment, we do have some currency related benefit coming into us. If the currency strengthens, it may have a deleterious impact on the margins. We will have to see how that plays out. So there are all these moving parts. Your guess is as good as mine. But on an average, if you have to ask me, if let's say currency strengthens or part of the currency benefit goes back to our customers, while US tariff comes down to 25%, European FTA kicks in, we should be able to operate at 12 to 13% EBITDA margin in India and about 10 to 11% in Africa.
That's really helpful, sir. Thank you so much.
Thank you. We have the next follow-up question from the line of Riddhesh Gandhi from Discover Cat Capital. Please go ahead.
Yeah. So just wanted to understand that, you had highlighted earlier when I asked you regarding that the impact of a 4-5% of benefits, which maybe Bangladesh, Turkey, etc., might have over us, won't be that much of an impact. But I understand it won't be that much of an impact in lieu of the 25%. But I mean, actually, wouldn't this be at risk of our customers looking to potentially diversify away from India?
Will they diversify away from India at between 25 and 20%? Answer is no, because in India they do get some specific capabilities, etc., that is very difficult for them to replicate elsewhere. People also want a diversified sourcing these days, given that tariff for any region can change any time. You saw how South Korean tariff suddenly go up by 10% based on some announcement by the administration. So people will stay diversified. Globally, U.S. tariffs are super volatile across regions and will stay volatile. And that really means that U.S. customers will stay as diversified as possible. We as supplier also should stay as diversified as possible, and hence look at sourcing from or supplying from other regions just to deal with this volatile tariff situation that we find ourselves in.
Got it. And just the last question I had was, I would assume, just given all the ambiguity, are the inventory levels that our clients send reasonably low, and how is end market demand looking like? So just to know that in case we do see a reversal of this 25%, do we also see an uptick in demand and orders relatively?
No, so I would say I'm a bit cautious there. I'm worried about U.S. U.S. inflation. Everything depends on U.S. interest rates, etc. going forward. But if U.S. demand slows in 2026, either due to price increases being passed on to customers or due to tariff-related price increases impacting U.S. customers, we may see some U.S. demand coming down. We also don't know how geopolitics are going to impact us, as there is enough on the boil globally, and how consumers tend to react to that situation in 26. So I wouldn't say there is going to be a demand upswing. On the contrary, demand growth will stay muted till this geopolitics plays out in 2026. We will have to ensure that we consolidate the supplier base, which we always do whenever there are some such difficult situations, and hold on to our business or try to get business in lieu of other suppliers, and we will continue to focus on that or think about that.
Understood, sir. All the best. Thank you.
Thank you.
Thank you very much. As there are no further questions from the participants, that concludes the question and answer session. I now hand the conference over to the management of Gokaldas Exports Limited for the closing comments. Thank you, sir.
So I have elaborated a lot during the call, as we will stay focused on trying to improve our cost as much as possible. Look at our supply chain wherever there is a possibility to extract more margins or optimize margins. The macroeconomic situation is still volatile. The only benefit that I see in all of this is a weaker rupee, which will help from an export standpoint. The tariff regime, we hope, will settle down soon. It is required, as U.S. continues to be one of the largest markets and one of the most consumption-driven markets for us. European FTA and UK FTA needs to come home as fast as possible. So while the announcements have had a positive effect, from a brand standpoint, looking at India sourcing, for it to take effect and business volumes to go up, we need to see the FTA being operational, which is some time away. But once all of those happens, the long-term benefit for India will be immense, as Europe is a fairly large market, almost as big as US is. And if US tariff comes down, I think it'll be good for operations out of India. In the meanwhile, we will continue to diversify. We will continue to expand out of Africa, and we'll continue to expand out of other regions and seek margin improvements wherever possible. Thank you.
Thank you very much, sir. On behalf of Gokaldas Exports Limited, that concludes this conference. Thank you for joining with us today, and you may now disconnect your lines.